This video has the ability to both radically alter and drastically improve your investing philosophy. And it's going to be so much simpler than you could have ever imagined. Investing can be as simple or as complex as you desire, but a vast majority do tend to opt for the latter option. They're operating under the impression that your thesis decision has a positive correlation to your probability of profitability. Or in layman's terms, people think more stuff look at, more number go up. Today I'm going to debunk many a misconception surrounding the topic of investing, and not just within Bitcoin, but for investing in markets in general, and prove that a simplistic, data-driven approach using a number of key data points with a standard structure and foundational belief system is all that's required to not just perform exceptionally, but to outperform a vast majority. Although something that we should consider is that a vast majority of investors are, simply put, plain bad. And this isn't just limited to everyday retail like you and I, far from it. Countless crypto companies have lost countless billions in the asset class's short lifespan, and this also doesn't fully factor in the preventable collapses and rug pulls that still plague the industry. But this phenomenon isn't just limited to over-leveraged CryptoPunk day traders, quite the opposite. Traditional finance experts and a $1 trillion asset management industry also fail to buck the trend of general underperformance. So what's causing this lackluster performance? Well, to start with, overcomplexity. It's people trying to outperform the market, time exact tops and bottoms, and trade their way from rags to riches. There's a bit of a negative stigma around keeping things simple. A misunderstanding that a simplistic approach suggests incapability of alpha generation. But the truth is literally the opposite. I'm simply inferring that investors in the pursuit of success often seem to have missed the forest for the trees. Playing short-term games of growing complexity typically exacerbates drawdowns, limits compounding, increases costs, and leads to far underperformance. However, potentially the most devastating knockback of all of this is it drains your most precious resource: time. It seems common knowledge at this point that patience is one of the key skills necessary for success long-term in investing. There's the age-old saying that it's time in the market rather than time in the market. But is this true? Do we have any evidence to actually suggest who the best investors are that we should potentially be following? Do you know who the best investors are? Dead ones. And this isn't a trait limited to technical traders developing complex systems that are overreacting to market movements. Many investors are often blinded by particular narratives and misguided by what they would consider fundamental happenings, news events, economic policy changes, and political differences. A lot of metrics that often influence decision making are typically doing much more harm than good. Here, for example, we can see some of the most impactful, influential, and seemingly eventful news events that have happened throughout all of Bitcoin's history. A lot of people will use these to actually base their investment decisions on. And again, this isn't just limited to Bitcoin and cryptocurrencies. There's fundamental news-based traders based throughout every single market class that one can invest in. From equities to commodities, Bitcoin and cryptocurrencies is just one more example. But looking throughout all of these news events, we can say that the average price 10 days following these events, price increased 53% of the time. What we can do is just see how common it is for Bitcoin's price to increase over any 10-day period. And the chances of that happening? 56%. Now, please do not conclude that this is all alluding to the fact that I'm about to suggest that there's some credence to the efficient market hypothesis. Far from it. Those involved within the finance industry and money markets may be the least rational participants of some of the most terribly inefficient market dynamics imaginable. In fact, a considerable portion of all of this stems from our second greatest influence on lackluster performance: emotions. It's almost impossible to not have any connection to your capital and investments. It's only human, and it's what we entrust and believe in to quench our thirst for unlimited wants in a world of limited resources. And in this ever-changing sphere of finance, it's never been more challenging. The constant barrage of get-rich-quick social media influencers, a tightening economy, and unpleasant reminders of how wealthy you could have been if only you'd have bought crypto at the bottom and sold at the top. It's easy, right? I mean, that's what most people did in previous cycles, isn't it? Thankfully, as Bitcoin is built on an open source blockchain, we can gain some insights into investor habits and actually verify the trades that they make. And after analysing all Bitcoin transactions from the 2017 cycle peak to our most recent all-time high in the 2021 cycle peak, do you know how many people in the previous cycle managed to buy Bitcoin on the day of our cycle low, hodl through all of the pullbacks, all of the FUD campaigns, and all those tempting points of take profit before selling at the absolute peak, the highest closing price day of the cycle? 1. Out of 6,446,331 wallets that existed at the time, or the 629,936 wallets that were active on that day, or the 547,131 that also bought on that day but sold prior to the Bitcoin price peak, this sole investor represents a 0.00016% of those who were active on that day, and that's more than 10 times smaller when taking into account the total amount of active wallets at the time, turning 2.04949 Bitcoin, or $6,761 at the time, into over $138,000. Something that has seemingly been framed as a common inevitability amongst investors, yet you're more likely to be struck by lightning in your lifetime. 421 times more likely, in fact. So what can we do about it? Well, first we need to entirely comprehend one of the most daunting economic principles: supply and demand. Yes, really, the concept you likely covered in the first 5 minutes of your mandatory Teenage Economics 101 class. Every second of every day there is someone selling an asset, and someone willing to buy it too. In fact, there's billions and billions of dollars of assets being bought and sold all the time, continuously. If there's more people buying than selling, and they're willing to pay a premium for the privilege to do so, prices increase, and vice versa for the downside. The markets we trade are just super efficient global bartering systems. But what drives this supply and demand? How can we model and predict it, not just within individual market classes, but to a universal degree? Well, first of all, we can look at sentiment, but not just crypto-specific fear and greed index sentiment. Here we can look at the appetite for high-yielding or riskier corporate bonds. Now, I know what you're thinking, why do we need to look at the sentiment surrounding corporate bonds for our crypto investing? Well, because ultimately it's really just the largest and most influential method of examining investor fear and greed on a universal scale. Yes, it pretty much is just a fear and greed index for traditional markets, but if we overlay this to Bitcoin, the results speak for themselves. Even in an industry of self-proclaimed market wizards, a majority let their sentiment and emotion get the best of them almost all of the time. But really, we did already know this. This is just helping us to visualize the demand for outsized market returns. And as with most metrics, acting as a contrarian is the real way to outperform. Of course, this is easier said than done. Acting against your instincts and biases is incredibly challenging to do. As opportunities peak, it's usually at what intuitively feels like the least opportune moments. So this is where taking into account metrics such as these, so we can very clearly see in black and white the global sentiment towards riskier investments and more speculative assets. This is how we can gain an unbiased insight to really ensure we're enforcing the best course of action for our own portfolios and investments. Luckily, we can also gain some insight into supply and the cyclical alterations that can be monitored to gain further clarity in the markets. And we're not just talking about the supply of the assets that are being traded, but the capital available for investors in the first place. We can look at global liquidity. This is the supply of sidelined dry powder awaiting more and more lucrative investment opportunities. M2 money supply is the total value of all cash, deposits in banks and other cash equivalents. And again, looking at the year-on-year change between global liquidity and the price increase or decrease of Bitcoin, it's so clear to see the correlation between these two metrics. One thing we also have to consider is not all money is real money, as in it's not necessarily money organically earned or saved. A vast majority of money is just credit. An alarming percentage of global capital is just borrowed on the premise that it'll be worth more in the future. Here we're looking at US specifics, and I'm not here to get political, we're simply observing the facts and acting on the data. So really, we have a chicken and egg scenario. Supply and demand, sentiment, liquidity, really they're all intertwined and impacting each other greatly. But really, it doesn't actually matter all that much. Again, we're not here to wildly speculate or even predict what data in the future may look like. A far more effective method of investing is to simply react to what the data is presenting to us. And this isn't just strictly for Bitcoin. If we look at the 1-year rate of change for global M2 chart that we have here, and look at the historic correlation to the same period rate of change to a global equity index, or specifically for this example, a US index in the S&P 500, over a typical length liquidity cycle of 4 years, throughout its entire history, there is a 73% correlation. That is actually considerably higher than just looking at the US M2 in isolation. But what's even more interesting is if we look at something like a global stock market index. This VT index contains 9,551 global stocks for a truly diversified representation of global liquidity and correlation. And over the same period of time and using the same measurements, we can actually see an 82% correlation. This is almost unbelievable and certainly an undeniable impact of more capital inflows around worldwide economies having a huge influence on the underlying prices of assets. But what's most notable so far is applying the exact same metrics to the price of Bitcoin. As Bitcoin bottomed out only a few months ago, global M2 year-on-year correlation hit 88%. What's even crazier than that, as Bitcoin peaked at its all-time high, the correlation was 97%. And a vast majority of economic data points are usually just a result of where we sit within the liquidity cycle. Mortgage rates, inflation, unemployment, debt, house prices, you name it. Too much liquidity in the system leads to higher inflation as people try to maximize their returns through excess borrowing and credit spending, leading to rampant speculation and a greedy sentiment based on a belief of never-ending prosperity. But in these instances, central banks can simply raise rates, incentivize debt repayments, and deter borrowing, which dampens sentiment and ultimately results in lowering price appreciation for assets. It's of course a tad more complex than this, but for all intensive investing purposes, expanding our scope of interest far beyond this is likely just going to cloud judgment and lead to paralysis by analysis. Just look at the S&P 500 when charted against the US M2 money supply for the most obvious proof there is of the undeniable correlation between liquidity and asset prices. Let me also reiterate quickly that asset prices do not necessarily reflect the economy. This is a very common misconception. And if you'd like any further evidence to support this, then just take a gander at asset prices in the latter stages of 2020 and into 2021. You know, when the vast majority of the world was locked inside? Well, let's compare asset prices of those periods of time compared to asset prices when everyone started working again and economies actually restarted producing things. I'd also like to take this opportunity to introduce you to the Bitcoin Trajectory Catalysts, or BTCs for short. These are the driving forces that dictate the price action trend for Bitcoin, digital assets, and markets in general. Or simply put, in other words, these are the most influential factors impacting the price appreciation or depreciation for Bitcoin. First up, we have macroeconomic data. This is going to be made up of a lot of things that we've discussed here today, such as global sentiment, liquidity metrics, traditional market factors, and other economic influences. These data points are the foundational bedrock for which all catalysts are derived and abide. It would take some naivety to imagine a truly sustained crypto decoupling from traditional markets occurring in the near future, given their historic correlation. It's even less likely to see an altcoin or even Bitcoin miner stock experiencing a truly sustained uncorrelated period either, given a vast majority of them are just following Bitcoin's price action with a higher degree of volatility and risk. Altcoins and Bitcoin dominance are actually a fairly good measure of the cyclical greed looking purely within the crypto markets. It's honestly pretty remarkable. The 4-year Bitcoin cycle has beautifully aligned with global liquidity cycles for all of its existence. Whether this was an intentional act of genius financial software foresight by Bitcoin creator Satoshi Nakamoto, or perhaps even more impressively a miraculous coincidence of beautiful mathematics in motion, we'll never know. But we can rejoice in the fact that it appears we've aligned once more. Secondly, we have Bitcoin fundamentals, a cornerstone in the trajectory of the crypto markets. Here we're talking key factors of influence such as the Bitcoin halving event, supply and demand, especially in relation to capital inflows, potentially maybe from a Bitcoin ETF in the future, and the ever-growing illiquid supply of circulating BTC. This does not imply that I'm a strict proprietor of the stock-to-flow validity, but to even consider that the halving events for Bitcoin don't have a substantial impact on price is just dumb. Here's a simple mathematical model we can use to prove this. So here we can see the current circulating supply of BTC. Now let's see what the circulating supply would be if we didn't ever experience any of the halving events. Now let's also assume that Bitcoin's total market cap would not have altered, which is a very bold assumption, especially considering one of Bitcoin's greatest monetary features is its decreasing inflationary rate and fixed max supply. The Bitcoin price would currently be a whopping $12,500, over $13,000 lower than it is as I film this video. And remember, as we have more halving events in the future, this divergence is only going to grow exponentially. Third, we have on-chain data, which still provides invaluable insights into Bitcoin's macro price cycles, and perhaps the best sources of accurate and unbiased models to help us anticipate and react to Bitcoin's speculative nature at either end of the market cycle. Mining data, network movement and activity, real underlying volume and not just synthetic derivatives. The decentralized and open source nature of cryptocurrencies gives unparalleled access to assess the underlying health of an entire industry unlike any other market class. Finally, we have the technicals. These are the on-chain points of interest we watch, the derivatives data we observe, and even the emotional sentiment we can use to clarify the intra-cycle volatility and movement of Bitcoin. Potentially more catered towards those more frequent traders than investors, but still a necessary tool to understand and implement from within the arsenal of any great investor. With these four catalysts, we can quickly, simply, and most importantly, unbiasedly gain a great level of insight into the potential future trajectory of Bitcoin's price. And this is especially true once we can combine them all for total confluence in an elegant synchronization. So where does this leave Bitcoin? Well, let's quickly apply everything we've learned today to our current situation. After recent lows in the 15 to 16k area, we did have a nice rebound into the high 20s, if not low 30s area, although we have retraced somewhat recently. There are even signs of some incoming institutional and maybe even sovereign interest too, especially given Bitcoin's higher risk-adjusted returns compared to all other assets as measured by the Sharpe ratio, especially impressive considering we've just had a far-extending bear cycle. We're also currently experiencing market-wide low-risk appetite and sentiment, whilst also undergoing a turning point in global liquidity. And also keep in mind, all of this is happening while Bitcoin is right where it's expected to be at this point in a cycle. And we also need to take into account that Bitcoin is still at levels that have historically provided the best risk to reward for accumulation. Looking at the forecast ahead, we may be about to see new highs into the upper doubles or maybe even triple-digit territory. And even though there is the chance of some unfavorable seasonal price action, it may be prudent to consider dollar cost averaging and chilling. This video was made not only to inform and entertain you as our viewer, but also to showcase what I personally would like to call Look Into Bitcoin V2. An overwhelming majority of the content of this video would not have been remotely possible without the new macro and portfolio tools we've included on the new and improved expanded Look Into Bitcoin site. And to celebrate the launch, we're also presenting a limited time 60% discounted offer to new subscribers for our Pro plans. And not only for your first month or first year either, this is a truly lifetime deal that you can lock in with a discounted price forever. Also, when I say limited, I really do mean it. This offer is only going to last less than 2 weeks from the time you're seeing this, so really lock that price in now if you want to take full advantage of one of our best discounts ever. In fact, no. I've changed my mind. If you subscribe to Look Into Bitcoin Pro right now and use promo code PRO70, you'll receive a whopping 70% off of a lifetime Pro subscription. But this deal really is limited to only the earliest subscribers, and this promo code will genuinely last only 1 week. So seriously, act now if you want to lock in literally the best available price for new subscribers forever. Also, if you haven't already, please do consider dropping a like on this video, subscribing, leaving a comment, following us on Twitter, sharing with your friends. Anything like that really does help, and we'd really appreciate it to commemorate all the work the Look Into Bitcoin team have put into making this new site a possibility. It really helps us to keep producing great future content releases, as well as new site features and overall improvements that we'll endeavor to provide to the absolute highest standard to cement our spot as the #1 source for Bitcoin data and information. Thank you all so much for watching, and I'll see you in the next one.